Hello and welcome to the May 15th, 2018 edition of the Alhambra Investments Biweekly Economic Review. I'm Bob Williams. We're going to talk to Joe Calhoun in just a little bit. As always, I want you to know that at the end of this, we're going to put up a website where you can go and read all of Joe's report. But we're going to bring Joe in right now. And, you know, Joe, you've got a big smile on your face today. It looks like something positive happened to you.
Yeah, Bob, thank you. Nice to be here again. Yeah, you know, I'd like to start today by talking a little bit about something that happened to me over the last couple of weeks. You know, I think that our country has become very divided, and I think that this politics has infected so many parts of our lives, and it's not positive. I mean, look, we've got, you know, both sides going at each other, and I think sometimes we just need a little dose of optimism. And so I got a little dose of that over the last couple of weeks I want to share with you. My sister and cousin and I own a piece of property down in Louisiana. Now, actually, a little aside there, I said Louisiana because I'm talking to a national audience. I never met anybody from that area who said Louisiana, because all of us natives down there call it Louisiana. That's L-O-O-Z, I do believe, is how that starts. But anyway, we own this property up in northeast Louisiana in West Carroll Parish, Louisiana. And it is a property that has been in our family since at least 1915. Although we're pretty sure that's just when they recorded the deed. We're pretty sure the family's been on that property since right after the Civil War in the late 1860s. And it's been in the family. So my sister and cousin and I have inherited this property. My sister and I from my dad, and my cousin from his dad, and we own this property jointly. It's an undivided interest. It's 125 acres, and a few years ago we planted it in native trees. We're in a USDA program that pays us to restore that land to its original condition. Of course, many years ago, my family cleared the land to plant things there. When I was a kid, it was a farm. We had goats and sheep, and as I remember, my uncle ran the farm, and the main crop was sweet potatoes. Now, I'm not sure exactly why sweet potatoes, but that's what they grew. And as I think I told you earlier, probably the only koi pond in all of Louisiana back at that time. I had a great uncle who had spent some time in Japan during the war and had fallen in love with koi, and he built a koi pond. And so we had these things, and all of us, all the cousins, we all went down there in the summertime, because it was my great uncle and a great aunt that lived down there. And so we went down and stayed on the farm in the summer to give our parents a break from our wild ways. And so anyway, we don't really make all that much money off this property. It's owned just probably, you know, just because it's been in the family so long and we've inherited it. But we do get paid a little bit from the USDA for this program to return it to its native condition. And we lease a little piece to a cell phone company for a cell phone tower. But my cousin usually takes care of the taxes, because all the checks come to him, and he doles it all out, pays the taxes, and sends us whatever's left over. And the taxes, I mean, it's 125 acres. You know, the taxes are like less than $300 a year, so it's not a lot of money. But anyway, a couple of Saturdays ago, I got in the mail a letter from the tax assessor in West Carroll Parish saying that our taxes had not been paid, and that if we didn't pay them by May 17th, that the property would be sold at auction. So obviously we didn't want that to happen. So I talked to my cousin, and I called the tax assessor's office on Monday morning. The lady there answered the phone, and I told her who I was and what I was trying to do. And she said, "Oh, Robert," that's my cousin, "is on the other line." So she said, "But we're taking care of it." She said, "Don't worry. The family farm has been saved. The taxes have been paid." And I said, Oh, did my cousin pay him over the phone? She goes, "No, you'll have to talk to him about that, but just suffice it to say that the taxes have been paid." Okay. So I talked to my cousin later that day, and here's the story. A man named Norman Calhoun in West Carroll Parish overheard at the local cafe while he was having his morning coffee that the Calhoun farm was going to be sold for taxes. Well, my cousin said, "Look, I don't know who this guy Norman Calhoun is. I don't think we have any relatives left down there." But anyway, long story short is that Norman went down and paid the taxes, $289 or something like that. So my cousin called him to thank him and find out what the story was. And he said, "Look," he said, "you know, I know that families fall on hard times sometimes, and I didn't want to see y'all lose this property over $300 worth of taxes. So I paid them for you. And he said, you can pay me back whenever you can. It's not a big deal. Well, my cousin, fired off and a check it to FedEx through FedEx and everything. Said, no, we're not hurting. It just, we had some problems. Something got lost in the mail or something. I'm not sure what happened. And turns out we're not related to the man. He does have share a last name, but there's lots of Calhouns in the South. So I just think that it just reminds us that we live in a pretty extraordinary country. And there are lots of good people left here. And this guy didn't ask what our politics was. He didn't ask if we were Republicans or Democrats. He didn't ask what our feeling was on Mr. Donald J. Trump. He didn't ask any of those things. He just saw what he thought was a family in need, and he took care of it. And I think that we need more of that. We need more of people helping their neighbors out and cooperating a little bit more in this economy, and I think we'd be a lot better off. So anyway, I just wanted to say thank you to Norman. I haven't met the man yet, but next time I get down to Louisiana, I certainly will go and meet him and buy him a cup of coffee because it was very, very nice of him.
Well, Good Samaritans still exist today.
They do. They're out there. And I think there's probably a lot more than people understand. Like I think the vast majority of this country is pretty nice folks. And, we sometimes, I think, get lost in seeing all this stuff on TV and online where people are pretty nasty to each other. But when you get down to the community level, I think folks are pretty nice. So anyway.
Yeah, it's a lesson for you and me. We need to be good Samaritans too.
For everybody, man. If you got an opportunity to help somebody out, you ought to do it.
Well, let's talk money and economy. I want to start today with the 10-year Treasury. It crossed 3% in the last couple of weeks, and everybody thought, across 3%, doom and gloom, world's coming to an end, and nothing happened.
Yeah.
We're exactly where we were before.
Yeah, people put these artificial kind of barriers on things. They go, oh, my God, if it breaks 3%, the world's coming to an end. And, of course, it broke 3%, and everybody kind of yawned. I don't know, 3% is just a number. And not a very high number, by the way. I think people are getting freaked out way, way too early here. 3% doesn't tell us anything great about the U.S. economy. It doesn't tell us anything terrible about it. But it certainly doesn't. It's not back to where it should be, I suppose, is a good way to put it. If we had growth in this expansion that was comparable to past interest rates, we wouldn't be talking about 3. We'd be talking about 4 or 5. And we're not. So.
Well, with rates where they are right now, we had that little run up above 3. I looked just a minute ago, we were at 299. Yeah. Does this say anything in particular about growth expectations?
Well, look, growth expectations have obviously gone up, but this is, what we've been talking about for weeks here, that, with the nominal 10-year Treasury around 3% and the 10-year tip around 80 basis points, that's right near the high end of the range that we've been in since 2013. So what it says is that growth expectations did rise to that, to that level, but it also says that, they're not going any higher than out of that range. They're just right where they've been. Now, look, I've thought a lot about this. I think that you could probably see the rate on the 10-year get up to 3.25 before this cycle's over. But we know the Fed's deep into the hiking cycle already. I don't know how much more you got. I don't expect to see it go a lot higher, but I wouldn't be shocked by 3.25. But bottom line is that we got up here and growth expectations started to moderate again because we started to get a little more weak economic data and things are pulling back. And of course, the yield pulled back too.
Then your expectation is still we're going to be in that 1.5 to 2 range, maybe 2.5 at the top end.
Yeah, I don't think that's changed. I think right now we're probably, and I'm guessing here, obviously, I don't, my crystal ball's functionally not working these days. Got a big old crack in it, but no, I think we're probably headed back to the 2% range. We've been up higher than that. In fact, year-over-year GDP in fourth quarter was up above 2.5, about 2.8. But I think we're going to head back to the middle of the range, and then we'll see what happens.
We've been hearing for several months now that companies bringing money back into the country, they're going to invest into their own companies. Are we seeing any of that yet?
Well, we see companies talking about it. We don't really see them doing all that much. We hear on the conference calls. We own individual stocks. So we get on a lot of these conference calls and listen to them. And we hear companies saying that they're going to increase capital spending. It hasn't really happened yet. And you'd be really, really hard pressed to find it in the data. If we look at capital goods orders and the durable goods reports and the factory orders reports, the capital goods numbers just aren't going up. In fact, they're going the opposite direction. They're going down. So are we going to see this surge in investment that everybody's hoping for? Look, I'd love to see it, but it hasn't happened yet.
Looks like a lot of the investment that did take place was in shale drilling. Are we seeing shale make a rebound now? Is it coming back?
Yeah, I think we are in a pretty big way, actually. Over $70, you start to bring in a lot more oil fields into that equation. And if you look at the regional Fed surveys, we saw almost all the regional Fed surveys have moderated and come back down, except for Kansas City and Dallas. And Kansas City and Dallas are really influenced by that shale industry. And in fact, what we're seeing now, there's an article in the Wall Street Journal this morning about shale companies are now looking again outside that Permian Basin, outside that West Texas area, because prices have gotten high enough now where they can go back and drill in some other areas of the country where the break-evens are a little bit higher. So, yeah, I think that investment spending in shale, look, I'm not going to call it a negative. I don't want to pick and choose winners here. Investment is good. Investment in shale is not ideal, but it is investment, and it does create jobs. It creates roughnecking jobs, or whatever you want to call those, for individuals working on drilling rigs and so forth. Yeah, they're good jobs. There's no doubt about it. Truck driving jobs, things like that. They don't change the productivity profile of the economy, though. Long term, we need investment in more intellectual property rather than in physical things like drilling oil wells. But in the meantime, we'll take what we can get, and that's what we're getting right now is a lot of shale.
When the price of oil got down to $26 a barrel, it just killed them. And like you said, now then we're above 70, so things are looking a little better there. There is some talk out there, and has been for a long time, about the U.S. having oil independence. With the price of oil back up and the fields that we have and some that are untapped, do you see the possibility that U.S. oil independence is a reality, or is it still just talk?
Well, I think it is just talk. I don't think we can pump that much oil. Furthermore, I would say I don't think it's a worthy goal. I don't think we want to be using up our oil resources. Look, it seems to me, now call me crazy, but it seems to me that if the Saudis can pump oil out of the ground at about $10 a barrel, and that's a rough number. I don't know the exact number in Saudi Arabia, but I can tell you it's a hell of a lot less than the Permian Basin in Texas. It seems to me that if they can pump it that cheaply, we got to let them pump it. Now, I realize that means a lot of profit comes out of this country and goes into Saudi Arabia, but ultimately that gets recycled back into the U.S. via treasuries or via some other type of investment. But the bottom line is that we have this finite resource. Shouldn't we use everybody else's before we start using up ours? Why would we want to deplete our resource, our finite resource, rather than deplete somebody else's, especially when they can do it cheaper than we can? Just my opinion, but I think that we ought to preserve the oil that we have and pump it when it needs to be pumped and when it makes economic sense to pump it.
If you play the U.S. dollar into that scenario, it seems a bit out of proportion at this point. The dollar-euro ratio got up to 124. Right now it's at about 119. We've seen a little bit of rally in the dollar. But the price of the dollar, is that what's pushing up oil prices?
Well, no, it's quite interesting, and this is something I touched on in the review this time, was that we did finally get a pretty good sized dollar rally, which we've been looking for. We've been talking about that, in these broadcasts for now, 4 or 5 weeks, 4 or 5 of these reports every 2 weeks. So the dollar rally is not surprising to us. What was surprising was that commodity prices really didn't come down that much. Look, I really thought that if you got a dollar rally, you'd see oil prices come down. Now, oil prices in particular maybe are being influenced by what's going on in the Middle East. Of course, we've got the Iran deal now has been revoked. I don't know that that's necessarily a bad thing, by the way. I don't think it was a very good deal to begin with. And I would point out that Iran is having some economic unrest, I think is a good way to put it, which means a lot of folks in the streets pretty mad because they're not getting paid, and pretty mad because their currency has collapsed. So I don't know if all that was intentional, but getting out of that Iran deal has, I think, raised the stakes in the Middle East. And I think that there's some premium in oil price because of what's going on there. But I think it's also interesting that we didn't see a pullback in other commodities really all that much either. Gold prices did not fall back that much, even with the dollar rally. In fact, I think gold is still in a nice uptrend. Yeah, you had a correction, but it really wasn't all that severe. And the same thing is true of other commodities too. Agricultural commodities have had a rally here recently, that was kind of a missing piece of the puzzle there. They rallied even as the dollar was rallying. Now, there's some supply-demand things going on there. There's been a drought in the Midwest. Kansas winter wheat was an awful, awful crop. And a lot of places in North Texas and Oklahoma, Kansas, and places like that, they got a drought going on that they're not even planning right now because they don't see any reason to. So I think there's some individual things going on with some of these commodities that are specific to those commodities. But bottom line is that we did not see the general commodity index correct hardly at all with the dollar going up. That tells us, I think what it tells us is that the market expects the dollar to go back down. Maybe I'm wrong, but that's the way I see it is that the market is saying, hey, this dollar rally is not going to last.
Well, with the dollar rally, does that push that global slowdown that you've talked about the last few weeks? Does that push it a little harder?
Yeah, it does. And, we've seen this in emerging markets in particular where emerging market currencies have come down. Emerging markets, but all around the world, really, a lot of what happens with economic growth around the world is determined by capital flows. And capital flows to where it's being treated nicely. And, of course, that means that they want to go where they want to own a currency that's going up in value. So when emerging market currencies start to come down because the dollar's rallying, well, then capital's flowing out of those countries in some ways. In some ways it is, some ways it isn't. But the bottom line is that it's not going to attract the capital inflow they need to grow. The emerging markets are very, very sensitive to that. But the whole world is sensitive to these capital flows. I would also point out that we do have a massive amount of U.S. dollar debt around the world. So anytime you raise the value of the dollar, it makes that debt harder to service, especially if you don't have dollar revenue to offset it. A great example is what's going on in Argentina now. Argentina, what's going on in Argentina is self-inflicted. They did impose a tax that made it less likely that people would want to own the peso. But they also have a problem in that they've had a lousy soybean crop. They got a lot of external U.S. debt, and they don't have the dollar revenue because their soybean crop failed. So, I think that in general, that's maybe a very specific situation, but it's one that we'll see in other countries if it continues.
In regards to that, you used a couple of terms in the report. I want you to go into detail for me. Stable versus strong.
Okay. I have advocated for many years that we have a stable dollar policy, that monetary policy and treasury policy, by the way, these things are intertwined, fiscal and monetary policy and treasury policy, ought to be advocating a stable dollar. Now, we can have an argument about what stable is and how you measure that. How do you measure the value of the dollar? But I think that the stability part is the most important. I hear a guy like Larry Kudlow, who's now obviously in the Trump administration as a economic cheerleader or whatever you want to call him, head of the Council of Economic Advisors. He's always talked about what he calls king dollar. He thinks the dollar should be strong. Well, strong, weak. I mean, that's kind of a nebulous concept. What's strong? What's weak? Strong against what? Weak against what? I don't know. Point is that stability is what provides companies and countries the ability to plan long-term. Planning long-term is dependent in a lot of cases. You look at these emerging markets. You look at what's going on with Brazil, for instance, where money comes flowing in. Brazilian real goes way up against the dollar, then it flows out and the Brazilian real crashes. It makes their economy a lot more volatile. If that relationship were more stable, then companies would be in Brazil and outside Brazil that want to do business there would be able to plan long-term and make investments that would raise long-term productivity and long-term growth. The stability part of this equation is much, much more important than the strong part. Strong is, in fact, in a lot of ways, a strong dollar makes the global economy weak. because of all this dollar debt out there. I suppose there's an argument that says, hey, well, raise the value of the dollar, make everybody, get rid of all this debt by, refinancing or whatever the case. But I think that's kind of, a pie in the sky type of thought. You kill all that dollar debt, you're going to kill the global economy. And I don't think you want to do that.
GDP report came in this time. Did you see anything that you like or don't like in this one?
Yeah, look, it was weaker than it looked on the surface. We had a goose from inventories of about 0.4%. If you look at real final sales to domestic purchasers, which is really a kind of just what's going on in the United States, then it wasn't that strong. We're talking 1.4% versus, a headline over 2. It just really wasn't that strong. Residential investment added nothing. So construction added nothing to the equation. We did see some rise in the investment side from business, but again, a lot of it was concentrated in shale. So, it's good, but it's not that great. Look, it was a typical first quarter report. We've seen this last few years where the first quarter tends to be weaker than the rest of the year. We'll see how it goes in the second quarter. Early estimates in the second quarter look better, but it's very early in the quarter.
What about CFNAI?
Yeah, CFNAI running about 0.27 right now on the 3-month average. That's slightly above trend. It means we're growing slightly above trend. It really doesn't tell us anything negative or all that positive. It's just kind of confirms what we see from all of our other indicators.
The trade report was a little better this time, but number one, is it real or is it just China and the U.S. marking their territory?
Gosh, Bob, I wish I knew. What I did see in the trade report is that imports fell. Falling imports is not a good thing. And by the way, the only time we've seen anything close to a balance in our trade account in my entire adult life has been during a recession when we don't import anything because we don't have the money to do it. I don't think that's where we ought to be aiming myself. President thinks that reducing the trade deficit is positive. I don't agree. I think the trade deficit is almost irrelevant. Now, I do think that we need to get our budget house in order. Look, if you want to fix the current account, you want to fix the trade accounts and balance those things. It's really about balancing our own budget internally. The reason we have a trade deficit, the reason we have a current account deficit is because we don't have sufficient savings. So we need more savings. Trying to fix the trade deficit through browbeating the Chinese, I don't think is going to work. In fact, I think it's going to make it worse. Here's the thing, though. I don't know, that drop in imports. With everything that's going on with trade, I have no idea what that number means. Is it negative, positive? I honestly don't know because we don't know what's been going on. We do know that, just to take one example, this company ZTE, which is a cell phone manufacturer, we imposed sanctions on them saying that they could not import U.S. parts to make their cell phones with, and they're just almost out of business. So how much, and ZTE is a huge company in China, how much does that impact the trade figures? I don't know. I really have no idea. I don't think anybody really does. But the bottom line is the trade figures, taken at face value, don't look that positive.
If we look at inflation, it looks like there's not much movement there. But if you do a deep dive into the numbers, is there anything there that's a positive or a negative?
Housing is a huge negative. Look, I keep coming back to this. I mean, we've got, price to, if we're looking at incomes versus rents or home prices, those ratios are back to where they were in 2006. We've had a lot of people convert to renting, and I think there's a lot of people who think that doesn't matter or whatever. But, when we look at various places around this country, there's a serious housing problem. Here in Miami-Dade County, where I am, we have 750,000 people who spend over half their income on their rent. That's just an astounding number. And if we look at all of South Florida, and I'm citing these because I just saw a report on this, 2/3, we have a big chunk of people in the 3 counties that we live in down here, Palm Beach County, Broward County, and Dade County, who are spending over 30% of their income on rent. That's kind of a number that the government looks at and says, if you're paying more than that, you're probably, hurting. Well, 2/3 of people in those 3 counties are paying over 30%. That's a big number. The only place we see any inflation right now when we look at the individual things is in necessities. Let's go back to that stable thing with the dollar again. I find it interesting that we run our monetary policy, and if you think about what they talk about headline inflation and core inflation. Core inflation, supposedly, is inflation minus, excluding energy and food. Okay, why wouldn't those things be core? You know, it's interesting to me that we have run monetary policy to stabilize the price of luxuries while allowing the price of necessities to fluctuate, and to fluctuate pretty wildly. Food and energy are basic components of every household's budget. And yet we spend our monetary policy trying to stabilize things like the price of an iPad. When somebody said it, I remember a couple of years ago, a few years back, there was a Fed governor giving a speech. And he was talking about what a great job they had done, how the price of an iPad had come down. And the fellow raised his hand. He says, I can't eat my iPad. And he's right. He can't put iPads in his gas tank either. That stability thing that we talked about. Look, if you go and look at the periods when we've had a stable dollar, whether it was versus gold or whatever the case may be, you know, the Bretton Woods era from post-World War II up to 1971, the price of necessities, the price of commodities, the volatility of those things was a third of what it is today. You know, a gallon of gasoline when I was a kid and working at my grandfather's gas station, as I remember, was 19.9 cents for regular. I remember pumping gas there. I was 7 or 8 years old. So that was 1968, 69, somewhere around there. That price really wasn't a whole lot different than it was in 1959 or 1949, because we ran monetary policy in a way that stabilized commodity prices. That's what it was concentrated on. I don't think it's coincidence that this large rise in inequality that we've seen started in the 70s. It started after we took monetary policy away from a gold standard of any kind. I'm not saying we should go back to a gold standard. What I am saying is that stability is important. And it's important to American families, especially lower middle class and lower class Americans who are budget constrained. You know, if the price of gasoline goes from $2 to $3, a lot of people are riding the bus. And it changes their entire life. We need to run monetary policy, and probably fiscal policy is involved there too, but we need to run monetary policy to stabilize the price of those necessities. Let the iPad fluctuate. We don't need iPads. We need gas and food. And we need to run monetary policy in a way that stabilizes those items for all Americans.
When you talk about purchasing, let's talk about credit cards. What do you see with credit card borrowing? Is it going up? Is it hurting us?
No, well, you remember a few months back, I said I had this little theory that the hurricanes caused people to jack up their credit card balances, because what happened, these hurricanes came in September and October, and people start filing their insurance claims, and they go, gosh, I forgot about that $5,000 deductible. And they had to come up with the money to get things fixed, and they did, and they turned to their credit cards to do it. So we saw a big surge in credit card usage and credit card balances in November and December of last year. And my guess was that we were going to see that moderate. Well, guess what? We did. I got one right. That doesn't happen very often. The last couple of months, we've seen credit card balances start to come in now and start to come down a little bit. A lot of people might say that's a negative. Hey, we need people spending for the economy. I don't see things that way. What we just talked about with that trade balance and savings, well, savings, paying down a credit card is the same thing as savings. It's no different, because paying down that debt is, in a sense, a form of savings. It's a good thing. Maybe not a good thing short term, but it is a good thing long term.
Last thing today, will the Fed raise rates once or twice between now and the end of the year?
Oh, gosh, I hate playing this game.
Yeah, I didn't mean the crystal ball thing, but
I don't know what they're going to do, man. And listen, I suspect that they will follow through with at least one more hike in June. Whether we get one after that, I don't know. It will depend on how the economy responds. Now, I'm not there's a Irving Fisher back in the 1920s and had a theory that, well, let me put this differently. There is a group of economists and a group of individuals out there who believe that raising interest rates will actually add to growth, that raising interest rates will actually raise inflation, which is kind of the opposite of what the entire world thinks. Now, I don't know that I would go that far. However, there is some truth to that. Think about this. There's a huge chunk of people in this country who have money in CDs, money in money markets and savings accounts and so forth, and they've been making zero. And the idea behind this was you lower rates to zero and it encourages people to borrow and spend, which causes the economy to grow. Well, maybe, but really what you did was you took money out of savers' pockets and put it in spenders' pockets. And I think that's kind of unfair to the folks who were trying to do the right thing and trying to save their money and trying to contribute to future economic growth by doing so. So as interest rates go up, those people now have income that they didn't have over the last 7 or 8 years because interest rates were pegged at zero. So those people now have money that they could spend or save more. I don't know which they're going to do and it's none of my business. So I guess what I'm saying is that I think people have this wrong idea about the Fed hiking rates. I don't think it's a negative. In fact, I was just thinking about that this morning. We're doing an asset allocation update right now. We have 5% of our portfolio in our moderate account is in cash. Well, until recently, until the last year when the Fed started hiking rates, we didn't make anything on that. To make a decision to put money in cash in your portfolio was very difficult to do because you were going to make zero. Now at least we get something. Heck, a 2-year treasury note gets you almost 2% now, or get you 2%. So, it's not a bad thing. So will the Fed hike? I don't know. Yeah, probably. Whether we get one past June or not, I don't know. Will the economy accelerate because the Fed has hiked rates? I don't know about that. I don't know that I'm willing to go that far. But I do think it's a fairer economy with interest rates somewhat higher. And I think that's important too.
All right, Joe, thanks for checking in, giving us your wisdom. Go be a good Samaritan.
I don't have lots of wisdom, but I will go and try to do my best to be a good Samaritan today.
All right. And don't forget, here is the web address for you to look at all of Joe's report. We'll be back for our next report on, let's see, this is May the 15th, so that would be June the 1st.